Imagine doing everything right. You save your cash, you keep each deposit a little under $10,000 so the bank does not have to file paperwork, and you think you are being careful. Then one day your account is frozen and the money is gone. That has happened to regular people who never broke a single law. The move they thought was keeping them safe is the one that flags the IRS the hardest. It is one of 8. Stick around, because most folks have never heard of half of these. This story does not really start at the teller window. It starts in 1970 with a law most Americans have never read. It is called the Bank Secrecy Act, and it quietly turned every bank in the country into a reporter for the government. Not a spy, a reporter. There is a difference, and that difference is the whole point of this video. People get this part wrong. They picture a man in a gray office watching their checking account like a hawk, jumping every time they buy groceries. That is not how it works. There is no person watching you. What there is, instead, is a machine. A quiet, patient machine made of forms. Your bank fills out the forms. The place that holds your stocks fills out the forms. The company that holds your retirement account fills out the forms. And every year, more than 3 billion of those forms pour into the IRS under everyone's social security number. Then the machine does the one thing it is built to do. It matches. It lines up what the banks reported against what you put on your tax return, and it looks for the gaps. When the numbers do not line up, a letter goes out. No agent, no audit, no human deciding you look suspicious. Just a computer noticing a gap and printing a notice. So when people say the IRS is watching your bank account, this is what they actually mean. They mean the reporting is automatic, the matching is automatic, and most retirees have no idea how much of their money life already lands on a government desk without anyone asking them first. Once you understand which moves set off those forms, the fear goes away and the control comes back. Let us walk through all 8, starting with the one almost everyone has heard a rumor about and almost nobody understands. Number 1, the $10,000 cash line. Walk into any bank branch in America with more than $10,000 in cash, deposit it or pull it out, and before you reach your car, a report is already on its way to the government. It is called a currency transaction report. The bank files it, you never sign it, you may never even be told it happened. This is where people panic, and they should not. Filing that report does not mean you are in trouble. It does not mean the IRS thinks you are a criminal. It means the bank followed a law from 1970 that makes them do this for any cash move over $10,000 in a single day. A retiree cashing out an old certificate of deposit sets it off. A widow selling a car for cash and depositing the money sets it off. A grandfather pulling out cash for a kitchen remodel sets it off. All of it perfectly legal. The report just creates a record. That is all it is. A dated note that says a large amount of cash moved. Here is who moved it. Here is when. If the money is honest, the record sits there and nothing happens. Here's the part worth remembering, because it sets up something far more dangerous later. The line is $10,000, and it counts your cash for the whole day, not per deposit. 2 deposits of $6,000 at the same bank on the same day still add up to $12,000, and the bank still files. You cannot quietly slip under the line by splitting it up at the counter. Remember that. We will come back to why it matters more than anything else on this list. Number 2, the interest you already forgot about. This one touches almost every person watching. If you have a savings account, a certificate of deposit, a money market, anything that pays you interest, then your bank is keeping a running count of every dollar it hands you. At the start of the year, it sends you a form, a 1099, that lists exactly how much interest you earned, and it sends an exact copy straight to the IRS. That second copy is the one that bites people. Maybe you opened 3 small certificates of deposit at different banks chasing better rates. Maybe a form got lost in the mail or buried in a stack of mail you set aside. You file your taxes, you forget one of them, and you move on with your life thinking nothing of it. The machine does not forget. That matching system I told you about, the automated underreporter, lines up the interest the banks reported against the interest you reported. If a bank told the IRS it paid you $800 and your return shows nothing, the gap lights up. Months later, a letter arrives asking for extra tax, plus interest, plus a penalty. The IRS calls it a CP 2000 notice. Retirees with money spread across several banks get these more than almost anyone. And somehow, it gets worse for the people who panic when the letter comes. That notice is not a bill and not an audit. It is a proposal, and you have the right to disagree. But folks who ignore it or who pay it in fear without checking often hand over money they did not actually owe. The fix is almost boring. Keep every interest form, add them all up, and put the full number on your return. The machine only flags the gap. Close the gap, and it has nothing to say. Number 3, the account that lives overseas. A lot of seniors have a foreign account and do not think of it as anything special. Maybe you retired part of the year in another country. Maybe you came to America decades ago and still have a pension or a small bank account back home. Maybe you help run an aging parent's account abroad. Any of those can pull you into one of the toughest reporting rules on this entire list. If the combined value of your foreign accounts goes over $10,000 at any single point in the year, even for one day, you are required to file a report called a Foreign Bank Account Report, an FBAR for short. It goes to the Treasury's Financial Crimes Network, separate from your tax return. And here is the trap inside the trap. This rule reaches past the money you own. If you are allowed to move the money in an account, like a parent's account you help run from across an ocean, that account can land on your filing too. This is where the story takes a turn nobody expects. The penalties for simply forgetting are harsh. An honest mistake with no plan to hide anything can cost more than $16,000 each time. Hiding it on purpose can cost you half the account. The government made these rules this tough to catch wealthy tax cheats hiding fortunes overseas, but the rule does not ask what you meant to do before it applies. A retiree with a small savings account in their old hometown is held to the same rule as a millionaire with a secret vault. The good news is the same as before. Report it, and the danger goes away. The accounts are legal. The money it earns is taxable, yes, but you can report it and handle it. The only people who get hurt are the ones who never knew the form existed. Number 4, the name you added to your account. This one feels like love, and that is exactly why it slips past people. You are getting older. You want to make things easier for your daughter, so you add her name to your checking account as a joint owner, or you sign a form at the bank naming your son payable on death so the money passes to him without going through probate. Simple, kind, and quietly tangled with the IRS in ways nobody warned you about. Add a child as a joint owner, and on paper they now have the legal right to that money. The moment they actually pull a large amount out for themselves, the IRS can treat that as a gift from you to them. Suddenly, a kind move comes with gift tax paperwork attached to it. On top of that, the interest the account earns gets messy. Whose social security number is it reported under now? If your name is first, it still flows to you, but shared ownership makes exactly the kind of gap the matching machine loves to flag. The payable on death way avoids some of that while you are alive, but it has its own quiet cost. When the money passes to your son and the account keeps earning interest in the time before everything settles, the reporting has to follow the right person or another gap opens up. None of this means you should never add a name to an account. It means you should do it on purpose, with your eyes open, ideally after one talk with someone who handles wills and estates. The difference between a smart move and a flagged one is usually just knowing the form was coming. Now, the one this whole video has been building toward, number 5, the careful move that is actually a crime. Go back to the very first thing we covered. The bank files a report on any cash move over $10,000. A lot of people hear that and have the exact same instinct. They think, fine, I will just keep every deposit under $10,000, $9,000 here, $8,000 there, spread across a few days, no report, no attention, no problem. That instinct is a federal felony. It has a name, structuring, and it is a crime under federal law to break up your deposits on purpose to keep them under the line. Read that slowly, because here is the part that catches honest people. The money does not have to be dirty. You do not have to be dodging taxes. You do not have to be washing dirty money. Arranging your deposits to dodge the report is all by itself the crime. Congress wrote it that way on purpose, and the courts have backed it. Worse, the bank is watching for exactly this pattern. A string of deposits at $9,000, then $9,500, then $8,800 does not look careful to the machine. It looks planned. The bank files a different report, a suspicious activity report, and that one is not normal. That one says, look at this person, and the move you thought was keeping you invisible is the brightest flag on the whole list. This is not made up. The government has frozen and taken the whole bank accounts of small business owners and regular savers whose only mistake was a habit of keeping cash deposits just under the line. Farmers, restaurant owners, a widow running a small shop, people who never sold a thing they should not have, dragged into court fights where the government kept the money, fights that took years and a lawyer to win back. The thing they believed was protecting them was the warning sign that started it all. So hear this clearly, because it is the single most important sentence in this video. Depositing $20,000 in cash is completely legal and just sets off a routine report. Splitting that same $20,000 into smaller deposits to avoid the report is a felony. The big honest move is safe. The small sneaky one is the trap. If you have cash to put in the bank, put it in. Let the routine report happen. It is nothing. If this is the kind of thing you wish someone had explained to you years ago, take 1 second and subscribe. This channel breaks down the money rules that quietly shape retirement, the ones nobody hands you a flyer about every single week. All right, here is where it gets into the moves most people never even think to worry about. Number 6, the wire that looked unusual. Wiring money is normal. You wire a down payment to a title company, you send money to a grandchild overseas, you move a big chunk between your own accounts. Most of the time it goes through and you never think about it again. But banks do not just send wires through, they watch the shape of them. When a wire is large or international or simply does not match how your account usually acts, it can draw a second look. A retiree who has moved a few $100s a month for years, who suddenly sends $50,000 overseas, has just done something the watching system notices. Not because it is illegal, because it is different. And different to the machine is worth a note. If the pattern looks unusual enough, the bank can file that same suspicious activity report we talked about with structuring. You will not be told. The wire still goes through, but a record now exists saying this move stood out. For honest money, that record is harmless. It sits in a file and nothing comes of it. The way to stay clean here is almost too simple. When you are about to make a large or overseas transfer, just be ready to say where the money came from and why it is moving. Selling a house, helping a child buy one, moving your own savings between your own banks. There is nothing wrong with any of it. The only thing that turns a normal wire into a problem is a person who acts nervous or hides things when a teller asks a simple question. Answer plainly and move on. Number 7, the generous gift with a hidden form. This is the one that breaks my heart a little, because the people who fall into it are the most generous people watching. You want to help. You give your grandchild $30,000 for a wedding. You hand your son a chunk of cash for a down payment. You are not trying to hide anything. You are trying to bless your family while you are still here to see them enjoy it. And you may have just set off a filing rule you do not know about. For the year 2026, you can give any one person up to $19,000 without any paperwork at all. A married couple can give $38,000 to the same person. That is per person you give to. So you can give $19,000 to each child, each grandchild, anyone you choose, and the IRS never needs to hear about it. Go over that line to one person, though, and you are supposed to file a form. It is called Form 709, and here is the relief in this one, the part that calms most people right down. Filing it almost never means you owe a dime. It is a tracking form, not a tax bill. It quietly counts against a lifetime limit that, in 2026, sits at $15 million per person. Unless your lifetime giving is heading toward that number, the form is paperwork, not a payment. There is even a clean way around it entirely. If you pay a grandchild's tuition by sending the money straight to the school, or pay a medical bill by paying the hospital directly, those do not count against your limit at all. Not the $19,000, not the lifetime number. Pay the school or hospital directly, not the person, and the generous move stays completely invisible. Number 8, the withdrawal you were supposed to take. This last one is not about money leaving your account that you chose to move. It is about money the law says you must move, and a high price for forgetting. If you have a traditional retirement account, a regular individual retirement account, or IRA, or an old 401k, the government let you put off paying taxes on that money for decades. Now it wants its turn. Starting at age 73 or 75, if you were born in 1960 or later, you have to pull a set amount out every year. They call it a required minimum distribution, or RMD for short. And the IRS knows your account balance and exactly what you withdrew because the company that holds your account reports both to them on its own forms every year. So this is not something you can quietly let slide. The machine knows what your RMD should have been, and it knows whether you took it. Miss it, take too little, or forget entirely, and the penalty is harsh. The shortfall, the part you did not take out, gets hit with a 25% penalty tax. A quarter of the money gone as a penalty on top of the regular tax you still owe. Now here is the mercy built into the rule, and it is real. If you catch the mistake and fix it within 2 years, taking the missed amount and filing the right form, that penalty drops from 25% to 10%. And in plenty of cases where an honest senior simply lost track, the IRS drops it completely when you explain what happened and show that you fixed it. The rule is harsh on paper, but surprisingly kind in real life for people who mean well. The takeaway is just this. Know your start age, mark the deadline, take the withdrawal. It is the one item on this list where doing nothing is the dangerous choice. Before we close, let me hand you a little peace of mind, because the internet has made a mess of this topic. You have probably heard a wave of fear about the IRS tracking every $600 you receive on Venmo or PayPal or Cash App. People were truly scared that selling an old couch online or splitting a dinner check would trigger a tax form. That rule was rolled back. In 2025, a new federal law brought back the old limit, and now those payment apps only report when you cross $20,000 and more than 200 transactions. So the thing half the country was scared of is not even watching you. That matters because it tells you something about this whole topic. The reporting machine is real, but it is smaller and more exact than the rumors make it sound. It watches large cash, dodging on purpose, foreign accounts, big gifts, missed withdrawals. It does not watch your grocery runs or your garage sale. Knowing the difference is the entire game. So go back to where we started with the careful saver who kept every deposit just under $10,000 because she thought that was the smart, safe, quiet thing to do. She was not a criminal. She was trying to be responsible. The cruel twist is that the move she believed was protecting her was the one move on this list that could actually cost her everything. Not because she did something wrong with her money, but because she did the wrong thing trying to stay invisible. That is the lesson hiding in all 8 of these. None of them are about hiding. Every single one gets safer the moment you stop trying to. The big cash deposit, the foreign account, the generous gift, the required withdrawal. They are all completely legal when you simply let the report happen and put the right numbers where they belong. The machine is not hunting honest people. It is matching forms. Feed it the truth, and it has nothing to say to you. One last thing, and it matters. I am not your accountant, your lawyer, or your financial advisor, and nothing here is personal tax or legal advice. Your situation has details I cannot see from here. Before you act on any of this, especially the gifting, the foreign accounts, or adding a name to your account, sit down with a pro who can look at your real numbers. Use this as the map, not the final word. If this helped you see the system a little more clearly, do me a favor and share it with one person who keeps their savings in cash or who just added a child to their account, because those are the two who need it most. Take care of yourself and take care of your money.